so don't get comfortable. Look, I don't dance now, I make money moves. Say I don't.
Before we can get into how to choose stocks, you have to know what investing even is. What is it? So investing is basically the act of you allocating a resource, such as money, in order to gain a profit. Many times people will invest in order to reach future goals, but we do not want to confuse saving with investing. Saving is considered a lot safer than investing because in investing, you have to always know that there are risks, okay? You could lose all of your money, but you also could gain so much more. But when you save, although it's safer because you're not going to lose your money, you can lose the value of your money because when you put money into a savings account, it might only grow by like 0.1%, 0.3%, like a low percentage, and then that percentage can actually be lower than inflation. So if inflation rises higher than your interest rate on your money, then you're kind of losing money, but it's like a lot less than like losing all your money, you know what I'm saying? I'll give and take. And within the world of investing, there are three main types of investment vehicles. Okay, so we got bonds, we have stocks, and we have mutual funds. And also, because I want to help y'all, we are going to talk about what the heck is an NFT, okay? Who is she? Who? Bonds.
Bond. James Bond.
So bonds are simply loan payments, really. You basically pay a company, a municipality, or a country, like literally a whole government. So basically, a government can be like, so you see, I'm trying to do this thing, and I want to build this park over here, but don't really got all the funds. Could you help a sister out? And then you, as an investor to the government, you'd be getting back interest, which in bond world is called coupons. So you get paid a coupon rate, interest rate, that you'll get paid yearly or biannually. It'll be specified. So with bonds, you're not only getting this reoccurring payment of the coupons, you're also going to re-get your principal that you paid in, and the principal is the amount that you paid in. So you're getting interest and the amount you put in, Investing, getting more out than you put in. And now we are going to talk about stocks. So unlike a bond, which is like a loan payment, when you own a stock, honey, you own a share of the company. Yes, I'm a shareholder, baby. Companies issue stocks in order to generate income for their business to operate. So say you're starting your business, as some of you probably are because y'all are big brain. So think about it like this. If you are trying to build a flower company, and you're like, I'm gonna be the best florist in the town, okay? But I only have like $10 right now, so I'm gonna need some people to help invest in my business so that I can have the money that I need to create the best floral shop in the town, because I don't have the money right now, but y'all can help me. And then as I get that money and I can invest in my company and make it better, and then I make more money, then we can all make more money, getting more out than you put in. But as stated, let's still remember that maybe your floral shop isn't the best in the town and then everyone loses money. The risk of investing. Now we are going to talk about mutual funds. But before we get right into it, I want to talk about diversification. As I've been mentioning, investing is pretty risky because you could literally lose all of your money. Yeah. And you know that quote, don't put all your eggs in one basket? That's basically diversification. It's saying that I should put my money in various different types of stock and bonds and all the other different types of investments so that when one is going down, one might be going up. So you're not losing all of your money. You might just be losing some, but actually you might be gaining money because this one's going up. And you just hope it all balances out because you diversified. But diversification can be especially hard for like your everyday investor, or especially your high school investor who might not even have $100 a month to invest. Like, how am I supposed to have a diversified portfolio if I'm broke? And this, my friends, is where mutual funds comes in. So a mutual fund is basically a pool of money that investors use, collected from different investors, like your everyday investors, that they will use to put in their diverse portfolio. Mutual funds can focus on a whole variety of investment types. If you want to invest in tech companies, it'll your money can be in a portfolio of a whole bunch of tech companies, or big or small companies. Oh, I only want to do the big ones. Oh, well, I only want to do the small ones. And if you ever heard of the S&P 500, those are basically the top 500 companies in the country. So with an actively managed fund, there are professionals, investing professionals, who are working hard daily trading their investment so that they can get you the highest return possible. And to explain trade a little bit more, basically it goes by the philosophy of buy low, sell high. So going back to our florist example, say you had $10 that you wanted to invest into the company that only had $10. So you invest your $10, and then that company gets, the best floral shop in the town, and now your $10 investment has now grown to $100. Well, do you know what the future of that floral company is? Maybe there's another one that's gonna open next door, and then your $100 is gonna go down to $5, and then you just lost basically money. So you might sell that $100 stock to someone who thinks that the company's actually worth way more than $100, and it's well, $100 to me is a steal, which $100 to you might be that's high. I don't know if this floral company is really the best in the town, So trade is basically the idea of I'm gonna sell this to someone who thinks it's worth this much money, and I'm going to get that money before I lose money. And it's all risky, because nobody really knows what the future of the company is going to be. And then a passive mutual fund is one that's not traded daily. And I know that might be oh my gosh, well, of course I'm gonna get the one that's actively traded every day, because these professionals, they know what they're doing, right? But even the king of investing, the king, the most pro of investing, Warren Buffett, would beg to differ. And I also forgot to mention that his net worth is over $100 billion.
$100 billion.
Warren's yo, no professional out here can choose 5 actively managed funds that is gonna beat the passive managed one. Impossible. I'm gonna bet $1 million. So then these other professionals yo, Warren, don't be down to my skills, okay? Roll my sleeves. I'm gonna show you how it's done. Because after 9 years, the actively managed mutual funds, they grew. People who did that, they earned about 22% more. 22% more. Okay. But y'all, the passively owned one grew over 85%. 85. You would think that these professionals who are making the most money out of any investor out there, who are actively managing funds out here, actively being oh, we should buy it, sell it, buy it, sell it, buy, do it. That those crazy stock pictures in the buildings of New York Wall Street. You would think that they would know how you can make the most money. But even Warren Buffett, the protege of investing, knows that just sitting and waiting and not really touching your investments is best. So I guess pro tip from Warren Buffett is chill. And now, the moment we've all been waiting for. NFTs. NFT, non-fungible token. What does fungible mean? So fungibility is basically an asset's ability to be exchanged or substituted for another good of the same value. So think if you have a $20 bill, if you go to the bank and you're I need to pay for my laundry, can I get $20 worth of quarters? They're gonna be those quarters. So quarters and dollars are very fungible because they're worth the same thing. If you have $20 worth of quarters, that's worth the same exact amount as $20 worth of actual paper money, It's very fungible. We know that they're equal to the same thing. They have the same value. It's easy to exchange them. With something that's non-fungible, like I said, it's unique. So unlike the quarters and the dollars, you can find 1 million quarters everywhere. You can find $1 million everywhere. Dollars and quarters are something that's there's so many quarters in the world, so many dollars in the world. It's not really something that's unique. I'm not just gonna have my $1 and no one else is gonna have this dollar. But something that's non-fungible is something that is unique, and you're not gonna find that somewhere else. So you can't just be I'm gonna trade this Mona Lisa for this Mona Lisa, because there's only one Mona Lisa. One. And so a token basically means that it's certified, okay? It has a digital certificate stating that it is unique, that is certified through a blockchain, which is a distributed, secured database that like allows that certification process to happen. So an NFT is a cryptocurrency that is non-fungible. So like a cryptocurrency can be like Bitcoin, except all Bitcoins are Bitcoins. They're the same. All NFTs, no NFT is the same, or it shouldn't be, because they should be unique. So let's think about something like the Nyan Cat. Yes, the viral meme. Someone bought it for over like $600,000. Because the real important thing about NFTs is people want to own the original. That is what makes an NFT an NFT. But don't worry, we're literally gonna have a whole video dedicated to cryptocurrency because there's a lot of confusion and a lot of things that you hear about, but we just what? Like I know the name, but like what does that mean? Like how do we work? How? And now you know like 3 of the most popular forms of investing, and you know what an NFT is? Look at you.
I don't dance now, I make money move. Say I don't gotta dance, I make money move. If I